trading patterns that we've been watching from afar or been involved in, there's been a lot of change in first of all access in terms of the apps that many new investors are utilizing that utilize confetti to promote additional activity on the app and additional trading. Essentially the impact of social media, the strength and the reach of it, markets hitting all-time highs. I mean, the list is long as to potential reasons why we're seeing this volatility and recent trading platforms that patterns that are coming from retail and primarily. So, Jan, you just launched an ETF buzz, which definitely caught a lot of attention, and I'm curious what your premise was behind the new Van Vector Social Sentiment ETF.
Sure. Yes, I think really there's two things going on. One is that there are a lot of retail investors playing in the market. There were in January alone 6 million app downloads for trading apps, and the biggest ones were Robinhood and Coinbase. So clearly individual investors are more engaged because of zero commissions and the crazy bull market of the last 12 months. But I think there's a separate trend entirely, which is that good ideas, good investment ideas are not the monopoly of Wall Street. I think Cathy do a shout out to Cathy because she's done a great job by sharing and being very open with the research that ARC produces. And so the concept of looking at all the messaging on investor platforms, whether it's DocTwits or Reddit or Twitter, and looking for signals and information in all those messages is really not a new one. It's been around for quite a while. The index that we track is also an index that's been a while. It uses natural language processing to take all those millions of messages and invest in large cap stocks. It's been around since 2015. And I think what we always look for when we launch a new ETF is a unique return profile. And this index, we think, captures not just momentum stocks, which one would think about with GameStop and everything like that, but also I'll call it contrarian plays. So in the fund and in today, there are some cruise lines, so some airlines, there's recovery plays as well. I'll call contrarian recovery plays, as well as sort of the big growth names of the FANGs and some of those other stocks.
Well, congratulations with your initial success on this. Kevin, Cathy, anything you'd like to add?
Well, I think what's going on right now has to do with the baby boom echo. There's an intergenerational wealth transfer taking place, and we do, thank you, Jan, for the shout out here. We do give our research away, and we engage pretty intensively with our clients with webinars and putting out our the top and bottom performers of the week and putting out our trades every day, disclosing our trades every day. The millennials and Gen Zs, to the extent they're experimenting here, they love learning. They're really excited about the new technologies that are evolving today. They're really at the leading edge of them and understand them and are comfortable with them. And I have been very gratified at the kind of response we've gotten to our research and the engagement, therefore, that we've gotten. I know that a lot of maybe regulators and people in the investment business are concerned that we're going to hurt the little guy here by allowing this kind of behavior. And sure, there's congressional testimony taking place, I think some this week. But I don't underestimate this group of people. They are actually more progressive, mentioned this, than I think the institutional investors are, because the institutional investors, over the last 20 years, tech and telecom bust, 0809 meltdown, have to face much more in the way of compliance. They have to jump through many more hoops if they want to stray very far from their indexes. And as you may know, I'm not crazy about the idea of indexes from an innovation point of view. It's kind of an oxymoron. Stocks and indexes are there because of their past success, and disruptive innovation is likely to disrupt the traditional world order. So I think that the heavily indexed or benchmark sensitive approach to investing is ripe for change, and I think that the retail investor, the individual investor, is actually leading the charge. Now, one other thing, just to focus on harm risk to the individual investor. These young people, and it's young and old people, anyone with a desire to understand how the labor law is going to work, they might speculate on Robinhood, but the beauty of what's going on is they're going to learn very quickly because losses impact psychology and sentiment much more than gains do. And so this period of risk off, risk on, I think is going to be very good in terms of teaching, especially millennials, those who have not had any training in the financial world. It'll teach them quickly that there are risks. Sure, opportunities, that's been the last year. There are risks, and you can lose a lot of money if you take too many risks. So I think they'll learn quickly, and I'm not as worried about that as others are.
I just wanted to add something about Robinhood, that because most people that have criticized it, particularly on the Hill, have actually never used it. I decided to join the Wall Street Bets crowd and became a member of the whole Reddit, call it the herd, if you will. I downloaded Robinhood. I put $10,000 into it. I called the CEO up. I had no idea Vlad would call me back. He did. And the night before he went to Congress, I wanted to offer him encouragement. I think he's done something very innovative and educational. He's the #1 app being downloaded, or at least he was during that period on the Apple Store. He's got over 20 million accounts. But here's a fact a lot of people I don't think understand. You cannot short stocks on Robinhood. There are many OTC stocks you can't trade. He's an engineer. He's a pragmatic guy. And I'll speak, I think, words of support because he's trying to stop young people who are using the platform to learn, even though it's been gamified, that's true, from blowing themselves up. You can't use excessive margin. You can't short stocks on market. There's so many things that are very educational. As a young trader, I learned pretty damn fast that you can really hurt yourself when you start to use tools you don't understand the power of. And he's removed that from the platform. I'd add one other thing that is changing institutional behavior. If you're in the business, these are usually hedge funds, 2 and 20 mandates that go into the Russell 2000 and short stocks that are very thinly traded with heavy short floats, you have new risk because the data information is less expensive and more accessible than ever before. And what I learned about the Reddit crew, they're not as dumb as everybody thinks. There's a lot of people there that understand that a very small amount of capital on the right situation can cause a tremendous pain for shorts. So they now have a new risk in their models. And I think it's going to be very difficult because that herd is riding every night, communicating sometimes hundreds of thousands of times, finding their next target and squeezing out those shorts like a teenage pimple. And for some of them, they're going to make money, but it's a whole new risk for the old traditional hedge model.
What's funny, Kevin, is I think the hedge funds are on Reddit. Smart guys like you are on these platforms too. So it's not one camp over here and the other camp over there. I will say though, there is a very legitimate concern about market manipulation, and I think that's why platforms like Robinhood or Fidelity, the one I use, limits your trading with smaller cap stocks. And the ETF that we've launched only invests in large cap stocks with $5 billion or more market cap. So that's something I want to note as well, that there is some bad behavior out there.
Yeah, and it's important that the SROs and regulators monitor for that, of course, which is something that we take very seriously as an exchange. We are coming up on the last 15 minutes of our discussion. I have one more question, kind of a broader question I'd like to ask. Love your views on, essentially as we begin to approach what we hope could be the post-pandemic world. There's no doubt we're not going back into the same normal. We are going into the new normal, like you had mentioned in your earlier comments. And there's been many innovations and much change brought about that's going to be here to stay, like the forum we're in right now. So just, if you can expand a little bit more on what industries, what trends, what markets will evolve as winners. Kevin, you already pointed to a few losers, which I certainly agree with. But what's your key takeaway for investors?
I would suggest that the new economy emerging, I like to call it America 2.0, has gone through a massive digital pivot. The successful companies are ones that are going to sell direct to their consumers on an ever-increasing basis, using the technologies that were made available and then tested during the pandemic. And I would argue at the large cap, just look at Nike's numbers. They've achieved something in 5 months that they thought would take 6 years. They're almost at 50% of their global sales direct to consumer, much less reliance now on the old retail model, which is very inefficient. Plus, they're getting a tremendous amount of data about their customers' wants, needs, desires, style, all that, and when they buy, and for what price points they buy, etc. And that mining of customer data, by the way, is not the purvey of large cap anymore. It's inexpensive. It's cloud-based. I have companies doing 50, 100 million that we're investors in that are using the same technology in all kinds of different sectors, everything from commercial kitchens to gym equipment manufacturing, greeting card companies, a wide range of insecticide manufacturers that have figured out a way to sell direct to consumers. And the stocks that are powering that are not just domestic. I mean, one of the indexes that O-Shares developed was Global Internet Giants, and we simply used the technology to go and mine data from companies' balance sheets and income statements. We simply asked the question, who's growing quarter to quarter in revenue and who's profitable, so their balance sheets every quarter get more and more powerful in terms of quality. And as a result, if you've done that indexing 20 years ago, 95% of the companies you find in would be U.S.-based. Today, it's only 60%. There are many, many companies people never heard of that are growing way faster than the FANGs all over the world and have become giant multi-billion-dollar behemoths. And those are the ones that we caught in our net when we indexed. That index was up over 100% last year. And they're not stay-at-home stocks. They're work-from-anywhere stocks. So I would argue the new economy is going to be using technology more than ever, including the S&P 500 companies. They're going to be cutting costs like business travel. They're going to be cutting their footprint in commercial real estate and in corporate offices. It's all going to go to the bottom line. And the losers are some of the sectors that have been winners the last 30 years. I mentioned airlines, but I also think REITs that are heavily involved in B-grade malls in America, that's going to be a tough one. Movie theaters, Cineplex chains, all of those kinds of things, they're going to have to be turned into cloud kitchens or whatever. But there's a massive change going on in America, and you have to be nimble to catch it. Because if you just index, you're going to have some problems.
I'll just jump in here. I just think, our firm, I don't know who on this call knows, but my father kind of made his name in the mutual fund industry because he took an international stock fund and moved to 80% gold shares in the late 1960s, anticipating an inflationary burst in the 70s, which ended up happening, which most people don't know is that gold at the time was pegged at $35 an ounce. And it had been pegged to the dollar for the basically entirety of U.S. history, so the prior 200 years. And so my mindset, our firm's mindset is the future can be really different than you might imagine it. And not just from a technology perspective, but from other perspectives. So I don't know what it will be, but I do say that there is a scenario now where you have GDP growth of 6, 7, 8, 9%. I just do not think it's priced into the market right now with long-term interest rates potentially going higher. So I agree with what Kevin said about owning equity. So just keep some cash ready for that kind of a scenario. And just to say, my favorite fund or ETF that we have right now is our Wide Moat ETF with the ticker symbol MOAT, which does use them forward-looking, human-based research, and it's a core strategy, a large cap strategy, but it does pivot between different sectors and different exposures, and it has a little bit more of a value tilt right now. So I guess that would be my favorite ETF of 2021 of the ones that we offer.
Great. Cathy?
Sure. Well, all we do is disruptive innovation. So I'm talking my book here, so consider it a source. But innovation does solve problems, and the coronavirus crisis created so many problems that thankfully our companies were able to pounce on and help solve. So we believe that over the